Welcome. This is Business Edge right here on News Central, and I am Joe Hanson. First, let's take a look at the headlines for today. Zimbabwe begins reclaiming underutilized farms. Kenya seeks 2.3 billion loan from IMF to aid economic recovery. Zimbabwe begins reclaiming underutilized farms is our first story for today, and the Zimbabwean government has started a process of reclaiming underutilized, vacant and abandoned farms to ensure that land is fully utilized, according to the Lands, Agriculture, Water and Rural Resettlement Minister, Anxious Masuka. Speaking during the launch of a traditional agricultural social security scheme in southern Zimbabwe on Saturday, Masuka said the government has started implementing the one-man, one-farm policy so that landless Zimbabweans can be allocated land. Masuka was quoted as saying, "The repossessed land will be allocated to the landless as we push to achieve the agricultural revolution aimed at making the country food secure." End of quote. Masuka also said multiple farm owners will be left with one farm. Those underutilizing the land will lose the portion that is not being utilized, and that abandoned or vacant land will be repossessed. Zimbabwe now imports grains to address a food deficit due to droughts and failure to fully utilize farmland by some farmers who benefited from a land reform program. The program, which began at the turn of the millennium, aimed at redistributing land from white-owned farms and estates, as well as state lands, to more than 150,000 black farmers under the so-called A1 and A2 models. Agriculture is the backbone of Zimbabwe's economy, providing employment and income to more than 60% of the country's population, according to the Food and Agriculture Organization of the United States, FAO. Joining me today on the program is Global Tax Advisor ActionAid, Mtwalo Msoni joins me on the program. Thanks for joining us. Welcome to Business Edge.
Thanks, the pleasure is all mine.
All right, so Mtwalo, I'm going to ask you this. Zimbabwe has been seeking the removal of sanctions to aid growth. Will this not further delay sanctions removal?
Well, naturally it would delay sanctions removal, but I think broadly the decision by the Zimbabwean government might end up being positive to the extent to which they'll be able to solve the actual problem that's there. And as you had mentioned, the decline in agricultural produce, the food deficits is coming in as a result of aspects of climate change, poor rainfall. So it's an aspect of to what extent does this repossession of land also respond to mechanized agricultural processes? To what extent would this be backed with farmer input support to ensure that these crops that seek to move from deficit to surplus are being farmed with the right machinery and with proper irrigation systems?
Interesting. All right, so first of all, over the years, indigenization policies are usually done along party lines. Will this not be like the Mugabe era?
You can't talk about this without linking it to the Mugabe era, but I think the only key difference that's there now is that most of the dormant land that's not being utilized is actually owned by Zimbabweans now. So it's an aspect of redistributing the land amongst the nationals of the country. But notwithstanding the fact that even the nationals who the land will be redistributed to would likely face the same challenges that the other nationals have been facing, the challenges of inadequate capital, inadequate infrastructure. And I think this is essentially what the Zimbabwean government should have addressed first. In as much as it seems progressive to some extent to look at utilizing underutilized land to increase productivity, to increase the contribution of the agriculture sector to the gross domestic product, I think it's essential to, first of all, try to to sort out the problem? To what extent is the Zimbabwean government actually trying to subsidize the agricultural sector, trying to reduce the costs that are being borne by the farmers and trying to support them in terms of bringing in the right capital, equipment, and machinery. So the redistribution might happen from one Zimbabwean to another, but if the aspects of adequate infrastructure is not sorted out, I think we'll continue seeing a dwindling agricultural sector in Zimbabwe, and they'll continue to import lots of grains from neighboring countries that have been trying to sort out these problems through an import support program for the agriculture sector.
All right, you just mentioned neighboring countries, but let's look at the international community as well. Is the international community saying anything, or are they swamped with internal crisis of their own, or they just don't care anymore? What is the international community saying?
For the international community, I think the interest is in ensuring that what happened years ago in terms of the land grabs, land reforms does not repeat itself. Essentially, for the international community, the biggest concern is that investors who have put in their hard-earned resources into the Zimbabwean agricultural sector don't end up losing these investments, even for those that have planned investments in future, but the agricultural production has seemed dormant over the few months and few years, probably would not lose this investment. So for the international community, the best interests are to ensure that people do not lose their investments, because this will actually make Zimbabwe at a worse position in terms of its outlook for foreign direct investment and attracting foreign nationals to actually invest in the country. And as you know, Zimbabwe considers the agricultural sector as one of its priority sectors, contributing to its employment and having the potential to actually be the backbone of the economy, supplying to neighboring countries in terms of different products. So for the international community, the biggest outlook will be looking at how this pans out, if there will be justice in how this will be done, and how this will affect people's investments will be a very big factor in determining other foreign direct investment inflows into Zimbabwe.
Well said. Let's look at the food crisis. You agree with me that food crisis already exists across Africa. Will they be able to make good use of the opportunity and possibly create wealth?
The wealth creation will be very much dependent on how an enabling environment makes it possible for farmers, for investors to bring in the much needed machinery in the agricultural sector. Of course, for commercial production of agricultural products, to some extent, you would need irrigation systems. You would need to have enough machinery to ensure that you have good climate adaptive agricultural systems because of the rainfall patterns recently in the SADC region. So this will be dependent on to what extent import duties on machinery, equipment can be done away with, so that we continue to support the sector in this way.
That's good to know. All right, so I'm just going to keep you with us for a few more minutes, so please stay with us. Let's take this break. When we come back, we'll continue with more questions and also still take a look at more stories affecting Kenya. Thank you very much for staying with us. This is Business Edge, and let's look at the next story that concerns Kenya. Kenya seeks a $2.3 billion loan from IMF to aid economic recovery. Let's look at that story quickly and get the analysis from this. Kenya is seeking a loan of as much as $2.3 billion from the International Monetary Fund under the lender's extended fund facility. The East African country hopes for an initial disbursement of about $725 million to fund the fiscal year that runs through June. Kenya Treasury Secretary Ukora Yatani says the loan is in continuous support of Kenya's COVID-19 response. The country is also looking at areas of reduced debt vulnerabilities through a revenue-driven fiscal consolidation. For nearly 2 years now, Kenya has abandoned expensive commercial debt to cut back on ballooning repayments, while revenue collection has been squeezed by the pandemic. As part of that strategy, it secured $1 billion in May, in the second ever in such direct lending for the budget from the World Bank, after the first was processed last year. That money was on top of a $750 million loan the World Bank doled out to Kenya in 2019. Talks are underway for yet another loan from the World Bank. Well, still on Business Edge, we have Global Tax Advisor with ActionAid, Mtwalo Msoni, looking at this next headlines. It seems Kenya has gotten its debt in order, but will the government want to renegotiate or just pay up later when revenue improves?
I think it's there's a broad way to look at this, and I think this is not the first facility that the Kenyan government would be benefiting from the IMF. Earlier in the year, 739 billion was dispersed to Kenya through the Rapid Credit Facility, which came as a response also to the coronavirus response, which of course saw Kenya being one of the countries to impose strict lockdown procedures, and to be also one of the countries that looked at the fiscal space and reduced its collection targets for the year 2020. Turnover taxes for small business was reduced from 3 to 1%. Payee personal income tax was also reduced for the highest tax band from 30 to 25%. We saw an increase in the lower threshold to $225, and so many other measures that would constrain Kenya's ability to raise this domestic revenue. And in response to that, of course, we saw Kenya benefiting from quite a number of loans and grants that have been given for COVID response. And most of these have been channeled towards social protection programs that are meant to cushion the country from the impacts of COVID. We do know that 40 billion Kenyan shillings alone had been paid for this purpose, for the Youth Empowerment Fund, for funds that were going to social protection, for the health sector, and so on and so forth. So this is money that has been coming in, but the extent to which the loan will actually perform and Kenya's ability to pay back depends muchly on how prudent the country is with these resources. If the resources are actually being used for where they have been planned to be used and have been used for the actual intended process, which is, in this case, COVID response. And we should say that this news is coming up just like 6 days ago. The IMF had concluded a visit to Kenya, where they had said Kenya is showing some slow signs of recovery in some of the key sectors. We do know that because of travel restrictions across countries, there are very few tourists that are coming into Kenya, and this is impacting on the balance of payments, which speaks to why they had to get this loan in the first place of 7.3 million.
Okay, that's interesting as well. Well, borrowing to finance fiscal policies has become the norm. When do you see this coming to an end?
It will come to an end as soon as we are able to ensure that our tax systems are progressive, efficient, and our tax administration systems can actually be able to harness the potential of the revenues in the resource. Kenya is one of the countries in East Africa which is said to have some over-generous tax incentives, which is said to have lost lots of money from double taxation treaties, which is also said to be one of the countries where their predominant illicit financial flows because of base erosion and profit shifting. So once we are able to seal these loopholes for domestic resource mobilization for a country like Kenya, then we can talk about the reduction in the dependence on debt to finance development. And of course, COVID response is quite unique in the sense that most of these expenditures had not been planned for earlier, and it's a pandemic, so countries have to borrow. But their ability to pay back will basically depend on how efficient their tax systems are. If they are going to take steps to do away with redundant tax incentives on income, for example, if a company is not making profit, why give it an incentive not to pay profit taxes anyways? So it will be dependent on how much revenue will be able to be collected from the potential big taxpayers that are finding a way to dodge, avoid, and evade taxes.
All right. Kenya is funding capital projects by borrowing, just like Nigeria and others. Do you see this trend stopping soon without going out to borrow in order to finance capital projects?
Sorry, I didn't get the last part of the question.
I mean, do you see this trend stopping soon? Kenya is borrowing in order to fund capital projects. I mean, just like Nigeria, do you see this trend stopping anytime soon?
It has to do a lot with country priorities. Nigeria, South Africa, and Kenya are some of the countries that looking at infrastructure projects as potential areas which will attract foreign direct investment and in the long term raise more revenue. But I think during COVID times, prudent resource management also entails cutting back on expenditure on capital projects like infrastructure and basically channeling resources to what we actually need right now, which are the social sectors, to ensure that the health sector continues to be well funded and we do not have a crisis that would see us going back to strict lockdowns and also having a health crisis that will see more and more people hospitalized. So it has to do more with budget prioritization right now, and the health and education sectors and the social sector, of course, through social cash transfer, are some of these areas that need to be put in. Of course, we can't undermine the importance of capital projects, infrastructure development in developing countries to spark growth and economic development. But I think the current context actually looks and calls for us to invest in the social sectors. And this is where the money is actually needed. Only when we recover would we continue with investing much more money in capital and capital expenditure, like you had mentioned.
All right. Mtwalo, looking at your profile, you seem to have a full understanding of how business is done in Kenya. So I'm just going to ask you, is Kenya investor friendly despite all the debt?
If you look at it, and this is in comparison to other African countries, I think Kenya is at a better position and is more investor friendly compared to other African countries, in the sense that its debt to GDP ratio is way less than other countries like South Africa, like Zambia, which is the first country to default on its debt in recent times. So I think investors would have enough confidence to invest in Kenya. And looking at probably projections for the mid-term future, Kenya has been mentioning a lot about looking at reducing on its debt portfolio and trying to generate enough local resources from local businesses and so on and so forth.
Interesting. All right, so let's look at the foreign direct investment. One more question for you. Are the bonds in Kenya worthy of attracting foreign direct investment?
Sorry?
Are the bonds in Kenya, is it worthy of attracting foreign direct investment?
The performance of bonds in most countries, especially during the COVID period, has not been that attractive. But I think Kenya also is one of the countries that stands out and should be able to generate foreign direct investment from their bond instruments. And given their plan for recovery post-COVID-19, I think this should be warrant enough for investors to invest in Kenyan bonds.
Interesting. Thank you so much, Mtwalo. You have been a great sport. Thanks for joining us on Business Edge.
Thank you. Pleasure's all mine.
All right, so let's go straight, still on Business Edge. Time for us to focus on NC4 to watch. And our first today on NC4 to watch, fintech space grew 800% during COVID-19 in Nigeria. Despite the pandemic, the financial technology payment space in Nigeria grew by about 800%. This was revealed by the Chief Executive Officer of EcoBank, Patrick Akinwuta, during a panel session at the FinTech Nigeria The State of Play virtual conference. Akinwuta said the growth came directly from the fintechs in collaboration with government agencies, indicating a huge trust in digital payment during the COVID-19 lockdowns, which prevented people from moving from one place to another. While calling for the proper regulation of the industry, the EcoBank CEO noted that the fintech space has been most active with payment and stressed the need for participation in savings and lending. And number two, Tullow Oil shifts focus to Ghana. Invest $2.7 billion. Tullow Oil has shifted its focus to West Africa as it plans to invest $2.7 billion in Ghana's oil fields, which form the backbone of its business. The move seeks to boost the firm's cash generation as well as secure the group's future. According to the firm, they will be able to generate $7 billion of operating cash flow over the next decade, of which $2.7 billion will go to the oil fields in Ghana, while $4 billion will go towards servicing its $2.4 billion of net debt and shareholder returns. Tullow expects to start a multi-well drilling program in Ghana in Q2 2021. As the Financial Times reports, the company has already produced 400 million barrels of oil from an estimated 2.9 billion barrels from its assets in Ghana. At number three, KCB Group to acquire more banks in Tanzania and Rwanda. KCB Group PLC and Atlas Mara have signed a definitive agreement which will see the bank increase its footprint within the region. It is through the acquisition of a 62.06% stake in Banque Populaire du Rwanda PLC and a 100% stake in African Banking Corporation Tanzania Limited from ATMA in Rwanda and Tanzania, respectively. The successful completion of the transaction is subject to obtaining shareholder approval and obtaining regulatory approvals in the respective countries. And let's check out number four. Safaricom-Vodacom joint monthly transactions hit 2.25 trillion. Well, let's look at the story. A joint cash transfer platform operated by South Africa's Vodacom Group and Safaricom PLC has recorded a surge in the 6 months ending 30th September 2020. According to the Vodacom Group's half-year interim results 2020, the M-Pesa platform generated transaction volumes worth $20.5 billion a month. During the period under review, Vodacom Group recorded an additional 4.1 million customers, bringing the total to 120 million customers across the group, including Safaricom's total financials services customers, including Safaricom, was also up to 13.9% or 6.7 million to 54.8 million. And that does it for Business Edge today. It has been a good show, no doubt. Thank you for joining us. Do not forget to follow us on all socials for more business stories. I am Joe Hanson. Thank you so much for watching.